Hello everyone, welcome to TTT Markets. I am Fotis and today we are unpacking central bank intervention, a topic every macro trader needs to understand. We will break down what intervention is, why central banks do it, and how it impacts markets. Then we will zoom in on one of the most watched examples so far in early 2026, the Bank of Japan and the Japanese yen. So let's dive in. Firstly, what is central bank intervention? Central bank intervention refers to any direct action taken by a central bank to influence currency values or financial conditions beyond standard policy settings like interest rates. The main goal is to correct disorderly markets or shift expectations, especially when market moves threaten broader economic stability. When and where can we have interventions? Well, they can occur in foreign exchange markets, like buying or selling currency to push exchange rates in a desired direction, bond markets, buying or selling government bonds to influence yields and liquidity, and other asset markets in extraordinary situations. Why do central banks intervene? And now I'm going to show you some headlines like this one. Japan PM vows to act against speculative market moves after yen spike. That was on Reuters. And as I said, how can they intervene? Again, three things: foreign exchange markets, they can intervene to buy or sell currency. Number two, bond markets. And number three, other asset classes. It could be equities in extraordinary situations. Why do they do it? Well, here are the common reasons. Number one, they have excessive volatility and they don't like it. If a currency swings wildly without clear fundamentals, a central bank may step in to reduce market disorder. Do you see this, the headline right here from Reuters? This is exactly what they are saying. Japan PM says that we are going to act against market volatility. We are going to act against speculative market moves. They do this, number two, to support economic policy goals. For example, they wish to stabilize inflation or to support export competitiveness. In this case, the Bank of Japan and the Japanese yen, the yen was getting extremely weak. What does this mean for internal inflation, for domestic inflation in Japan? That pushes inflation high. This is not acceptable. So what do? They intervene and they wish to strengthen the yen because they were seeing speculative moves, and this is something they couldn't tolerate. Number three, they wish to prevent financial instability. Sharp moves in FX or bonds can spill over into banking, investment, and confidence channels. I can say into real estate, into the domestic consumer. So there are three reasons: excessive volatility, to support economic policy, and to prevent financial instability. How do they intervene though? Well, the simplest form of FX intervention is for a central bank directly to buy or sell its own currency against others. For example, if a currency is too weak, a central bank might buy its own currency using foreign reserves to prop it up. If a currency is too strong, it might sell its own currency, which increases supply and weakens it. In this case, in the case of the Bank of Japan and the Japanese yen, even signaling they are about to intervene, that did the job. They didn't need to go ahead and buy their own currency or sell their own currency. even suggesting that we are ready to go ahead and intervene, it was enough to do the job. And this is called verbal intervention. So what is verbal intervention? Like this one that happened the previous week when I'm doing this video. So this is public warnings or statements signaling willingness to act. Central banks might ask dealers about pricing to send a message that they are watching. This is called a rate check. So let me say that again. Number one, we can have a verbal intervention. Number two, we can have a rate check, as you can see right here. A rate check speculation. What is a rate check? Again, the central bank is going to interest rate dealers and they are asking about pricing. And this is sending a message that they are watching and they might go ahead and intervene. Markets respond to these signals even before real intervention happens. So this is something you need to pay attention. Now, what happened in Japan in January 2026? So let's take a look at dollar yen. So the Bank of Japan was recently holding interest rates. They said we are not going to raise rates. They were keeping them steady, even if inflation and wages have risen. So they are keeping their policy rate at around 0.75%, which is the highest in decades, but still they are sending the message we are not going to hike, we are not going to raise interest rates. So that kept the yen, as you can see here, weak against the US dollar. So in late January 2026, the yen experienced sudden sharp spikes, you can see over here, and the way that traders interpreted this, it was as a sign of central bank rate checks or tentative intervention attempts. This is a 2-hour chart. Let me show you, I think it is this candle. Let me go to an even smaller time frame. Let's do 15 minutes, for example, so you can see. As soon as the news hit the market that the Bank of Japan is rate checking, look what happened. Look at this candlestick. Can you see the spikes? Spike to the downside. Huge candle to the downside. It went from 159.16 in 15 minutes. It went down 200 pips. And this is because of what? This rate check. It's what we discussed. Remember, rate check means authorities contact dealers to understand where is pricing, to see where is pricing, and this is a signal that any minute now we are about to intervene. So these sudden swings, including a significant yen rally right here against the dollar, fueled speculation that authorities were stepping in to stabilize the currency. Japanese political leaders also signal a willingness to take action against speculative market moves, adding to expectations of intervention. The Bank of Japan, and especially the governor and other officials, they had been very clear that they are watching markets closely and prepared to act if moves become disorderly. So they moved from verbal intervention to an actual signal that we are about to make it happen. Very often, there is also a psychological level that is very important. So we are watching levels like 160. Everyone was saying dollar yen near 60. This historically has triggered intervention in the past. So approaching 160, approaching these levels can itself change positioning, and we can have the sellers becoming very aggressive. Can we be more certain if we watch a cross-market analysis? Yes, changes in Forex also affect bond markets and equities, meaning intervention expectations can flow through multiple markets at once. So central bank intervention, isn't just about outright buying or selling the currency. It is the signal that matters, as it is the case of the Bank of Japan and the Japanese yen. They didn't actually intervene. They signaled they are going to intervene. And this is actually extremely important. Verbal cues, rate checks, political statements can move markets even without official transactions. So what happened in January 2026? The Bank of Japan, it had kept the rates unchanged because of volatility. They had seen the yen fluctuate sharply. They had created strong speculation around coordinated or standalone intervention by authorities. And for traders, understanding both policy mechanics and market psychology is essential when central banks enter the picture. Thank you for watching. If you find this helpful, hit like and subscribe. Drop a comment on what central bank topic you want next, maybe quantitative tightening, yield curve control, or FX carry trades. Thank you and see you in the next video.